lleno de cambios, pero hemos sabido adaptarnos y hemos encontrado nuevas oportunidades. Un nuevo mundo en las inversiones ha llegado para todos. Existe una estrategia de inversión para cada estilo, personalidad y perfil de inversión. En Skandia, nos transformamos para brindar un valor diferente en el manejo de tu dinero. Investor. Porque sabemos que cada inversión cumple con un objetivo diferente, queremos guiarte para que tomes las mejores decisiones. Skandia es asesoría, experiencia y conocimiento. Ofrecemos asesoría financiera personalizada, una selección de productos, amplia gama de fondos de inversión locales y globales, portafolios de inversión premium Skandia y estratégicos de acuerdo con tu personalidad como inversionista. Un nuevo mundo en las inversiones llega ya. Skandia. Tomemos decisiones conscientes.
And within the regions, there's, and using MSCI Asia Pac as our representative here, there are about 15 countries in this region, but I'll really just predominantly focus on the largest countries, and I'll provide some backdrop for those. So let's turn to the first slide. Do I have control or does somebody else have control? Okay. So I'll just reference to the slides, and whomever is controlling, I'll just reference the slide numbers to turn to. So to give you a little bit of history with regards to Franklin Templeton Investment Solutions, we are the multi-asset arm of Franklin Templeton. And so Franklin Templeton overall, as many of you have known, has recently acquired Legg Mason and all of its affiliates. And so currently today we stand at about 1.4 trillion in AUM in US dollars. And you can see the breakdown of assets on the right-hand side here. So the multi-asset division, which is called Franklin Templeton Investment Solutions, is about 140 billion of that. And we sit globally across all the different regions around the world. And it's not that, we have one investment team in one region, another investment team in another region. All of our different analysts and portfolio managers sit across everywhere. And we find that to be of tremendous value in the sense that we are really able to get information live from the different regions and have boots on the ground in the specific regions, as it helps us to inform both our bottoms up view as well as our top down views from a multi-asset perspective. So with that, I'm going to turn to the next two slides here. So turning to slide 2, this is it gives us an overview of where we stand from a multi-asset perspective. So the first 2 slides really highlights our high-level overview of our overall portfolio positioning. And so we currently, sitting here today, although the market's kind of falling out from underneath us right now, we still hold a moderately optimistic stance towards risk assets. And the reason being that, while we do see light at the end of the tunnel with the US elections and the inauguration successfully behind us and the vaccinations rollout well underway, we do recognize there are still significant risks, 2 of them being, one, really driven by the uncertainties regarding virus mutations, and that's kind of really has taken a hold globally, and also from the perspective of vaccinations, we see healthcare companies really trying to develop new vaccinations to address the mutating virus, and so as that unfolds, we are recognizing that as an uncertainty. 2, the implications of the record amounts of fiscal stimulus that's being deployed globally. And it's kind of a double-edged sword, right? And while we do recognize that the fiscal stimulus is positive, we do also recognize the risks that it poses to us over the long term. So as we weigh all of these factors, and in looking out, particularly the next 12 months, as holding period really does matter, as we look, whether it's near term or long term, over the next 12 months, our expectation is for inflation to be moderate, and with the continued stimulus, for that to be supportive for risk assets. And so when we turn to the next slide, we can see how this translates us to being, one, overweight equities, And we're moderately convicted on that, and with that being funded from fixed income. And within fixed income, clearly that's being driven by the record low rates, negative yielding rates globally. However, within fixed income, we still see pockets of opportunity, and that's not within the purview of this discussion today, but we are seeing pockets of opportunity, particularly in the senior loans and the emerging market debt region of the world, really on the basis of being shorter duration in nature and also being able to collect that extra yield while yields are low globally. And you can see that being reflected in the cash line item, whereby we are more favorable on that, predominantly due to the shorter duration nature of that. So turning to slide 4, we're going to now turn to focus on the Asia Pac region. Particularly, I'll focus on the larger countries and discuss the evolution of our views through 2020 and how we're viewing them today. So to provide context, MSCI Asia Pac represents about 20% of the MSCI ACWI, All Country World Index. And within Asia Pac, there are 15 countries, and the top 2 countries, Japan and China, represent 58% of the weight. And the top 5 countries, which are Japan, China, Australia, Korea, and Taiwan, they represent 85% of the weight. So very concentrated here. And so Asia societies, as we all know, Asia societies and governments have generally handled the COVID crisis much better than their Western peers. They've engaged in strict lockdowns and have led to dramatic GDP losses, but really only over a short period of time. And the compliance around preventative health measures ultimately led to communities with much lower COVID crisis, much lower COVID cases, and therefore were able to reopen and rebound much more quickly. And so they essentially took the approach of rip the Band-Aid off, and that really had allowed them to recover much more quickly and benefit from the rebound in H2 of 2020. Furthermore, the policy responses in Asia were generally much stronger and within the Asia regions when compared to the Western regions in terms of their strength and their speediness. And so what this chart shows here is just, you can see the COVID cases count and the disparity between the Western regions and the Asian regions here. So turning to slide 5, as we continue to evaluate the impacts of COVID, the challenge moving forward really is about how we should define success, right? So the focus really has been shifting from the number of infections around the world to the number of vaccinations. And so as we start to think about, how a region is responding to this pandemic, the shift really is focusing. And this is a key inflection point that we're watching as Asia, while it has benefited from how it's controlled COVID, it really is quite far behind when you think about the number of vaccinations it's deployed when compared to the US or its Western counterparts. And this chart really highlights that. So the darker the color, the greater the number of vaccinations it's deployed. As you can see, the US is up there, and then Latin America, and then in Australia. However, you can see the rest of the world is really quite behind that in pace. So turning to slide 6, we'll now focus on more of the individual regions. And this slide shows our Japan positioning over the course of the year and then where we are today. So Japan, as it's 33% of the MSCI Asia Pac, we do dedicate quite a bit of time on this region and do have specific positionings with regards to it. So Japan really started off 2020 on poor footing. They had implemented a consumption tax hike in October of 2019, especially as we were starting to enter into the 9th inning of a bull market cycle. We viewed that implementing a consumer tax hike would really be detrimental, especially in an economy that has high operating leverage. And so that had pushed them into a negative quarter-on-quarter GDP growth. So starting around mid-2019, we were negative and remained negative and underweight that for the better part of 2020. However, in anticipation of the eventual global recovery, particularly a goods-led recovery, coupled with attractive valuations, we started to gradually reduce our tactical underweight to it being now the second highest conviction overweight that we have within the equities, within our equities carve out. And so, our first largest overweight is the US, and with Japan now being our second highest conviction overweight. And that's really coupled by several reasons, predominantly being valuation. And I'll go over a few of those slides later on to highlight why we are so bullish on Japan right now from a tactical perspective. However, from a strategic perspective, we are cognizant of the fact that they do have slow vaccination approval process, and coupled with aging demographics, it continues to present headwinds for Japan. Their economic momentum has remained choppy, with consumer sentiment remaining weak. The government is pushing businesses to invest, and we do think that they will have some mild success there. And we recognize that the government may be the biggest source of growth via their active policy and spending. So strategically, we are still mildly bearish on this, but for the next 12 months, our outlook from a tactical perspective is positive. So turning to the next slide, we can see, what are the underpinnings behind our tactical overweight. We can see that from an export perspective, they didn't suffer as much of a drawdown when compared to the rest of the world. They are an exports-led economy, a goods-led economy. So you can see that, while they had a drawdown, it wasn't as significant when compared to the rest of the world. And they've really rallied back and are near pre-COVID levels already. And then you can continue to see that, what's driving that. If we turn to the next slide, Japan's economy is very much driven by the auto sectors, right? So globally, there has been a big boom in consumers really buying cars, especially as mass transportation has taken a steep decline. People aren't wanting to be in close quarters with other people during the COVID crisis. So this transition towards individualism, taking individual transportation, having individual homes as opposed to living in apartment buildings, living in tight quarters, we can see that transition of behavior, moving globally. So the sharp increase of car purchases globally has really helped Japan recover quite quickly. So while there was a temporary shutdown of plants, that backlog has been recovered, and now we see that continued demand resuming. Turning to the next slide, we look at profit margins. And so, as I mentioned earlier, with regards to the high operating leverage that is systemic in the economy of Japan, we see that impacting its profit margins. And so you can see that over on the right-hand side here, it really has plateaued. And we think that has really caused its valuations to be extremely cheap. But now that we are seeing light at the end of the tunnel, we do believe that there is positive upward momentum here. So we believe that this is a plateau, and it is trending upwards from here, at least for the next 12 months. And therefore, that inflection point really helps solidify our more optimistic view on Japan. And so, as I mentioned earlier, in the next slide here, you can see valuations. All of the causes that I had mentioned earlier from a strategic basis, as well as its high operating leverage economy, really has caused its valuations to be quite beaten down. So on the top here, you can see both MSCI Japan's valuations on a price to book basis, as well as ACWI ex Japan's valuations. And you can see that Japan, even though its valuations have climbed relative to ACWI ex Japan, you can see that it is still quite cheap, which is on the bottom chart here, on the bottom part of the grid. So really, that really helps to solidify, our view. So when we look at positionings, we really look at three things: fundamentals, valuations, and technicals. And so while we recognize over the strategic basis or from a long-term basis, the fundamentals may be more neutral to bearish. However, from a valuations and technicals perspective at this juncture and looking out next 12 months, which is our tactical time frame, we can see that those two should really serve as a tailwind for the Japanese region. So therefore, this is currently our second largest overweight. Now, turning to the next region, we're going to focus on Japan. And Japan, again, it represents the second largest weight within the MSCI ACWI at about 25%. And that weight has really increased quite substantially, as you would guess, over the past decade. Japan's power, let's turn to slide 12 here just to show our positioning over the past 12 months and where we are today. So we've been slightly more tactical with our China positioning, as we enter 2020 with an overweight on the basis of troughing relative growth, improving profit margins, and attractive valuations. Also, at the time, we believed that the virus was really just limited to Wuhan as opposed to all of China. However, when it was clear that the ramifications were more severe, we then neutralized our weight in February. And in seeing and understanding the extreme measures and controls that were put in place by the Chinese government, we reinitiated our overweight on the thesis that China was going to gain control of it much quicker and much more effectively. And it did. China's sharp lockdowns and its more compliant population led it to being the first country to sharply grow following their Q1 2020 decline. China's recovery offered insight into behavioral changes, notably the continued weakness in service sectors, and while the goods demand normalized much quickly. So we started to really recognize, what impact this would have globally, and really China gave us that insight into the trajectory of this virus as it would roll out throughout the world. So as a result of that, we then neutralized our overweight position in May. Arguably, probably it was a little bit too early as China continued to do better relative to the rest of the world. But we did so given the continued uncertainties around the trade and the growing US-China relations. And we also did so in trying to lock in our gains after China rallied quite significantly in H2. However, some of this uncertainty was alleviated with Biden's election, which allowed us to reinitiate that overweight in November. However, after an 18% run-up from the end of November to January 25th, to be exact, we then neutralized this position. And arguably, again, probably a little too early. This region is a continued source of discussion within our asset allocation committee, given the many nuances with regards to government control and the ongoing US-China relations, as well as China relations with the rest of the world. And so we, therefore, as you can see, we've definitely been a lot more tactical with this region when compared to the rest of the world. Let's turn to the next slide, slide 12. And, I'll go over into some of the details, as I mentioned earlier, as to why we've been a little bit more tactical here. As you can see, profit margins within China really have declined throughout 2020. And on a relative basis, Chinese margins have held up better and provided the scope for outperformance. And you can see what I've circled here on the right-hand slide here. That's really predominantly focusing on 2020. You can see its profit margins had peaked and is now starting to recover, especially when you compare it to the rest of the world. Turning to the next slide, China is, from a valuations perspective, is really trading on par to the rest of the world, as you can see in the bottom part of the grid. And so even with its absolute re-rating of 80%, as I mentioned earlier, its sharp run up in 2020 and as it continues in 2021, it's still quite attractive. from a valuations perspective when compared to the rest of the world. So again, despite the the other nuances that I mentioned earlier with regards to the U.S.-China relations, the extreme controls that the government has on China with regards to policy, this is something that we are continuing to debate and will probably continue to remain quite tactical in this space. When we look at its PPI, you can see that its downward trend really has troughed and has now turned up, and it coincides with higher corporate profits, right? And that is something that we're continuing to look at, especially when you look at its corporate profits with regards to its state-owned entities, and that's something that's quite optimistic for the country. Turning to slide 15, as we all know, that activity within China has been resuming and is pretty much back up to pre-COVID levels, probably limited to within China as they aren't really traveling outside of China yet. But, one anecdotal evidence that we have here that is optimistic on China is, one of our consumer discretionary analysts, as we have these continuing discussions with regards to deglobalization, one of the things that she said was quite resonating is that, it's one of the few regions where the manufacturing plants are still open and functional. And so as this is a goods-led recovery, people are sitting at home and ordering and shopping. Where are the factories and the manufacturing plants that are able to really be able to deliver on those goods? And the only place that has been able to do so reliably is China. So as much as there's been discussions about, onshoring of plants and continuing to bring manufacturing plants back to their own countries, that's going to take a long time to transition. That's a multi-year project. And in doing so, as of right now, the only place that can deliver on that is China reliably and consistently. So that's still, that really does put a wrench into how long this notion of deglobalization and onshoring will continue. So turning to slide 16, we can see that production, re-highlighting that production has recovered. While that is the case, consumer confidence continues to remain below pre-pandemic levels. And this is consumer confidence within China, just to highlight. And you wonder why that is, and a lot of that is because things are still closed within China, right? Travel abroad, which was very big amongst the Chinese community and the Chinese population, is still closed. There is still a lot of government control and government oversight to an even greater degree at this point. And so, as we highlight that, another point to really bring into account is turning to the next slide, you can see that the trade impact is still very uncertain, and that does impact the psyche of the Chinese population and the Chinese economy. And so, as people start to think about deglobalization, there has been a lot of conjecture as to when the economy does open up and when it is safe to do so, where will these manufacturing plants shift to, right? And clearly, other Southeast Asian countries where labor is still cheap has really been the place that people are thinking about. But clearly that is not until at least 12 to 18 months out before they can even start to think about that and the economy start to open up. So turning to the next slide here, we're going to start to look at the Asia ex Japan and China for the remainder of the slides. Just shifting to slide 18, if possible. From a valuations perspective, the region really has been attractive, even after a re-rating in H2 of 2020. However, as we evaluate, as I mentioned earlier, from a fundamentals, valuations, and technicals perspective in our framework, for most of 2020, the bulk of 2020, actually, the fundamentals were quite unfavorable. And I'll go into the reasons why. So while valuations were quite attractive, the fundamentals were quite unfavorable. And so for the better part of 2020, we were underweight the Asia Pac ex Japan region, as well as Japan. We were underweight, and that really proved to be beneficial. It was one of our largest contributors. However, we are seeing that pivot into 2021. So we have recently neutralized our Asia Pac ex Japan region. We are neutral there, as well as overweight Japan, as I mentioned earlier, and neutral to mildly bullish on China. So as we turn to the next slide, you can see within Australia, which is the third largest region, financials and materials makes up approximately 53% of the index, which was quite an unfavorable backdrop as we were headed into the ninth inning of an expansionary cycle. However, with the superior handling of the COVID crisis, and despite a low approval process for vaccinations, we pivoted to be positive on the Australian economy. And this really helped to drive our neutralization of our Asia Pac ex Japan view. And this is really driven by two reasons. One, Australians remain extremely willing to take the vaccine when you compare it to a lot of other countries, which are a little bit more cautious on the vaccinations. And two, the RBA, the Royal Bank of Australia, has explicitly pledged to keep rates low for several years, effectively a form of yield curve control. And so also coupled with the backdrop that employment trends remain positive, and therefore having that strong labor force really helps to support during that recovery. So in the next few slides, I'll just go over some key supports from Australia, sorry. So as you can see, employment trends remain robust here. As we said, having a strong labor force and full participation in the labor force is key to this recovery. And you can see that for Australia here, not only do they have the recovery from an employment rate perspective, but also from a participation perspective. So that's a positive. Their housing permits, as we turn to the next slide, their housing permits increased at an accelerated pace after Q2 of 2020. As I mentioned, the Royal Bank of Australia has committed to keeping rates extremely low for the next 3 years. So they have a definitive timeline there. And so with rates near zero, mortgages are essentially zero there, which really helps keep the housing economy strong. Turning to the next and final slide here, the Australian household savings rate is extremely high, and couple that with a low debt service load, it really provides cushion for increased debt levels. And so that also helps the economy. And so just to really touch upon the other regions here of the top 5-6 regions within the Asia Pac, Korea and Taiwan. Again, it's a goods export-driven economy, particularly tech and semis focus, which has led to its outperformance. And we expect this to continue throughout H1 of 2021. But we are monitoring this transition of growth being driven by goods as the economy starts to open up, and we expect the service sectors to start to open up. We are monitoring that progress. And then lastly, Hong Kong. Hong Kong, starting to experience some stability. But regardless of that, I think its continued tensions with China will continue to exert lots of influence over it. And so while it's starting to see some of the stability, we do think that it's from a technical perspective, its ties to China and its ongoing tensions there will continue to provide some volatility, or continue to make it quite a volatile region. And therefore, we are more neutral to bearish on that region. So I know that's covered a lot, and I haven't been able to read some of the questions that have come through as I was going through. So, perhaps we can turn it back to Jaime or Julio to go through some of the questions.
That's great, May. Thank you so much, and that was very, very insightful. Now we're going to move on to, into a little conversation between, let's say, Jaime, you and me.
Sure.
Then at the end, we're going to open the space for some questions to the public in general. And for some of you that joined us a little bit later, we are here with Tong. She's a senior vice president in banking Templeton. She has a lot of experience in asset management, and we are talking about the Asian Pacific opportunities and markets. As an introduction to our conversation, historically in Mexico, most of the, let's say, of the investments and most of the behavior of the investors are based on either local markets or the USA, and obviously the USA because the relation that historically has been between each countries. So my first question to you, May, is why do you think an investor, either retail or institutional investor, should consider to invest part of the portfolio on the Asian Pacific markets? What's the rationale or the logical to focus part of the investments on that region?
Yeah, so as a multi-asset investor, that's a very great question, because we think about one, what are the benefits of each of the regions, one from a diversification perspective, from an overall portfolio view, but also what are the opportunities, right? Especially from a tactical perspective. As I highlighted earlier, for the better part of 2019 and 2020, we were fairly neutral to negative for most of the Asia Pac regions, including Japan. And now, as we see that there is light at the end of the tunnel from this vaccinations rollout, as well as how Asia has really controlled and dealt with the crisis, and also understanding the nature of its economy, what's driving it. So if you look at Australia, it's predominantly a materials and commodities-led region, and those types of regions tend to do better in a recovery, right? There is demand for materials and commodities in a recovery. If you look at Korea and Taiwan, which is also a goods-led sector, primarily focused on IT and semis, that's something that we're watching, and clearly those regions have benefited in this type of market, and we continue to think that it should do well for the next 12 months, while we are still in this goods-led recovery part of the recovery, for lack of a better term. And same for Japan. It's really more of a valuations-based story. Really that it's low valuations, and from a technical perspective, it has really handled COVID quite well. And so we think net overall, it is a quite a promising time to be in Asia. But again, we are stressing that this is more of a tactical view. So looking out next 12 months, looking out, let's say, longer term strategically over the 5-year period, you can get a little bit more nuanced within the regions. But overall, over the next 12 months, we are quite optimistic on the region holistically. For many different reasons, clearly region by region, as I noted, but overall, it is a promising region, especially as to how it's dealt with everything, and how it's positioned in a recovery phase.
Perfect. That's great, and that's perfectly clear. And now I'm going to move on to Jaime. Jaime, we consider in our retail portfolios international investments, right? If you can explain a little bit how we're investing in our retail strategies in what we call our premium portfolios on international equities, and how you are positioning Asian and Pacific investments on those portfolios, so people and distributors can have more clarity on how Skandia is taking those opportunities into our strategies.
Yes, thank you, Julio. And I actually will attach this answer to your previous question, because we have certainly seen people in the last years trying to go more international and decrease the local exposure, especially to equities, because the international equities market have done much better than the local markets. And I think this is a trend not only in Mexico, but also in Latin America. And then when we started seeing what the investors are looking abroad, the first thing that comes to their mind is the United States. So we definitely have seen that people in their first choice of diversification go to the US. And then they start thinking after a lot of time on international or in the US market of other regions. Typically, Europe comes in the second place in their minds. And Asia has been a region that has not been very present in the minds of Latin American investors. And I think this is the time when this has to change. We particularly provide a couple of alternatives on how to go into Asia. One is through personalized portfolios, and through those, you can go directly actually to a fund that invests directly in Asia, 100% in Asian shares. We distribute that fund from Sura, or the other way is to invest in a fund that is a global fund. We manage that fund. And as any other global fund, what we see is that, yes, 55% of it is still the United States, but Asia itself is beginning to grow and grow in the percentage that it represents. Right now, as May said, it's about 20% of the index, and we have actually brought it a little bit above that 20% because of the things that May has mentioned. We think that Japan has a valuation history that's very interesting. Japan is a very different economy, very different from what's Latin American. Because of that, there's a lot of diversification there. In fact, it was highlighted that about 2 weeks ago, the Nikkei index finally went back to 30,000 points, which was a level that it had in the 1990s. So we saw definitely a very long downward curve, and now it's going up. So Japan's story, we think it's very interesting. And then China itself, also with different markets, and we might get very technical here, but China itself has like 2 markets: the H share market, which was the typical market for foreigners, and some years ago they opened up the A share market, which is what usually was restricted to local investors, to Chinese investors. And I think now that opens a lot more possibilities of having more diversification, access to much more interesting companies. And because of that, we're continuing increasing our exposure to Asia. So that's another alternative, to go through a global fund like the one we manage. And with it, the investors will get also exposure to Asia on a very diversified way. And at the end of the day, it's a story of diversification from the local, from the house or the country investments that investors might have.
No, that's brilliant. Thank you so much. I believe that the important message to the audience and to our investors is that, in one hand, you as an investor can get access to these type of investments without big amounts of money, and the other is that Skandia has been considering, not now, let's say some years ago, the option on investing on international markets, because I mean now the option to consider global investments is there, and we have the platform, so we can do it. So going back with you, May, on the pre-COVID times, we saw a lot of tension between the U.S. government and the Chinese government. Do you think that tension now under Biden's administration is going to be, let's say, driven on a more healthy way between each of the countries, or we will expect once again to see a completely different, let's say, positions between each one of the countries?
Yeah, that's a very good question, and kind of an interesting one, right? I don't think that anyone would deal with China the way Trump has dealt with China. So I think what Trump did was he opened up and made to light a lot of the issues that were probably, I would say not that they weren't known, but he brought to light a lot of the issues. And now that they are to the forefront, Biden's administration has to deal with them. However, I think Biden will definitely deal with these in a lot more politically correct manner and in a diplomatic manner. In his inauguration speech, he used democracy and diplomacy, those two words, quite a bit. So I think that they will be dealt in a lot more diplomatic manner. However, she has an agenda. Xi Jinping has an agenda, and he's going to stick with it, and he's not going to cave, regardless of how Biden appeals or how diplomatic Biden is. I just think that you're not going to get those crazy rhetorics. You're not going to get the crazy tweets, and I think the tension certainly would subside because there isn't any of that language or rhetoric that Trump would put out there. So I think it remains to be seen how it will play out. But I think she is quite convicted in his agenda of making China, a supreme power. He is looking to really make China more self-sufficient, as we most recently saw his JV, or not his, but the PBOC's JV with SWIFT, right? And that was announced, I would say, last week, and that was really on part of its reinitiative from the 2015 financial market reform, whereby he's really trying to internationalize the RMB. In alignment with what Julian said earlier about really trying to open up the Chinese economy. This is one of its attempts to do so, right? In this JV with SWIFT, which is a Belgium-based global payments network, it's really to allow it to internationalize and open up the RMB and make it more global in a non-US dependent way. And so I mean, he attempted something like this, or China attempted something like this back in 2015, but unfortunately, as we know, that the global economic slowdown of 2015, 2016 really, caused that to be quite a bit of a disaster, and he put that on hold. So in putting this infrastructure in place with SWIFT, it really helps to reignite that initiative. So there are huge developments in place within China to really help both local institutional asset managers to invest abroad, but also to the point earlier about having these additional share classes, the 8 shares, the ADRs, the N shares. It really allows more foreign investments in China, and therefore, by having this greater investment, it should help bring down some of the volatility in trading of China.
Oh, that's great. Thank you so much, May. Jaime, and before going into the public questions, one last question from my side. If we go back, let's say to the last years and the last decades, the leaders on the markets and on the economic, let's say, production, different areas has been either United States, Europe, England, but now, I mean, we from some years ago, we are hearing and listening that the next generation of leaders will be in basically in Asia, right? So why do you think China will be leading the world in the next years, and what could be the risks for that region to actually reach that position of leadership?
Well, yes, that's an interesting question. In my view, we have, trends that are basically signaling that, yes, that China will become the largest economy in the world, perhaps in 5, 6, 7 years, and will surpass the United States. Of course, that is only part of the story. The other part of it is that China itself has a very programmed plan of growing. In fact, they still keep the 5-year planning that is a legacy from the Communist Party when it was in full swing. And in this 5-year plan, the last one that they've disclosed, the one that's going to rule from 2021 to 2025, they've put very clear goals as to how to become that powerhouse of growth. Basically going into domestic demand, targeting domestic demand, switching from being the factory of the world to being much more of an intellectual property factory. In fact, right now, China has the largest patents in the world, or has been filing for patents in the world in the largest scale, and has surpassed the countries that you mentioned, the US, Japan. So those are signs that clearly they are in that path. Of course, they have a huge population, and part of their plan is also to bring the per capita GDP to a level similar to the one that other emerging markets in the higher range have, like Korea. Right now, they are having a per capita GDP of around $10,000, which would be similar perhaps to some Latin American countries. But their target is to go all the way to what Korea, for instance, has achieved, which is more than double that. So in that sense, I think that their path is there. They're very planning into that. They're also planning to become more self-sufficient in terms of semiconductors, which was something that May also mentioned. And that's perhaps going to be the base of the new technology-driven economy. So I think there's a lot of signs that can tell you that, yes, that China is going there. Of course, there will be challenges. The debt levels of the households is going to be a thing to be careful. Also, in general, to see how the social composition of China starts changing, of course, from being perhaps a country where there's more centralized power to perhaps have more freedom, such as the one we're used to see in the United States or in general in the Western Hemisphere. So I think those are challenges that we will have to see how they evolve. But the patterns that we're seeing are clearly sending us the signal that China is going to be there, and it's going to be the first economy in terms of growth in the next years.
Agree with you, Jaime. May, we're almost on time. I don't know if you schedule another meeting. If that's the case, we can address Jaime and myself the questions that we have on the chat. So please let us know if you can continue with us for a few minutes.
Yeah, absolutely.
No, that's brilliant.
Yeah.
Thank you. So, okay, there are many questions. I'm gonna pick 2 or 3 questions from the public. One interesting question here from Armando Rosales is, what level of interest rates could we expect if we decide to invest some of our capital in the Asian market, low risk and medium risk? So I don't know, Jaime or May, if you want to take that question. He basically wants to know if he decides to invest with, let's say, low risk, what could be the rate that he can get on his investments?
Perhaps I could go first, May, if you allow me. And that's an interesting question, because we've only focused in this webinar on the equities market, but there's also a bonds market, a fixed income market, especially in China, which is growing a lot. In fact, in terms of the size of the market, the Chinese bond market is the second largest market behind the United States. However, I think that if we in Latin America are not used to Chinese equities, much more or less we're used to Chinese fixed income, Chinese bonds. So I think that's an asset class that we actually in Mexico, I haven't seen any manager going really in full to the Chinese fixed income market. They're having relatively high yields for the rating that they have. China has a rating of around A+, and a country like that is giving in their case a 3.5% interest rate in the 10-year space. So it's definitely a high yield, but again, it's a market perhaps that we haven't actually explored in general in Mexico or in the United States. So it might well be the next asset class that we will start looking to integrate in our multi-asset portfolio. So that would be my take. May, I don't know if you want to add something.
Yeah, most of the Asian currencies are low to negative yielding, with the exception of China. And so to your point, I'm seeing roughly at about 3% right now on Chinese government bonds. But the rest of them, if you look at Australia, it's pretty much zero. As we mentioned earlier, it's committed for real rates actually negative. Japan has been negative for God knows how long, right? But that's actually one of the currencies that we would actually say, as we are a long only equities, multi-asset, but within our equity side, that is one of the currencies that we would actually say to not hedge right now, because having that Japanese yen exposure, although you don't get any yield, it's negative carry on it, it does serve diversification benefits on the currency side of things. And so but if you look at Taiwan dollar, extremely negative in terms of rates. Korea, Hong Kong, pretty much flat to negative yielding. So we don't see really any potential from a rates perspective there. The only one that's positive is China, but to your point, there's not a lot of transparency there. So hence probably the higher yields given the ratings. So
yeah, so that's why we would continue to look more favorably the equities market rather than the
exactly.
And if I can add something additional, we in Mexico we have a legacy of high interest rates, and that could create a perception that we can receive those type of interest rates in some other regions. I mean, in general, most of the developed and not developed countries are having very low interest since the pandemic started. So I believe that the option to get important returns on fixed income, it's quite difficult at this stage. Okay, so moving on into Carlos' questions. He has two questions. I will pick the Japan one because we already discussed a little bit more time on China. He basically is asking which country is Japan's biggest trade partner, and in addition, what is driving the acceleration in the auto industry according to the slide that you presented on the, let's say, on the car traction that Japan is gaining.
Yeah, so Japan's largest trading partner is China, and I think it's roughly about 22% of all of its exports. Autos being a big driver of that, and China being one of the largest consumers and purchasers of cars. And the US is second with approximately 19% of all of Japan's exports. In terms of the acceleration question, so the acceleration is mainly due to autos, machineries and electrical equipments, which makes up about 50% of its annual exports.
That's perfect. Thank you so much. Okay, and let's go to the final question, and that's also an interesting question because actually in our vision in Skandia and on this concept of an open and modern platform on investments, we are following very closely this ESG, let's say, trend, which is happening in different markets, in different regions. Actually, as a commercial, we're gonna open a new option on the short term for our investors on the ESG type of investments. So the question here is from Jorge Izquierdo. He would like to know May's view regarding ESG factors investments in the main Asian markets. That's a very important and brilliant question to see your view on the ESG, let's say, trend on the Asian and Pacific markets.
Yeah, so ESG is something that we're working on. I think everybody's working on right now, and clearly Europe has been the most advanced with regards to being ESG friendly and being ESG aware, with the Western markets following after that. And I would say that the Asian markets are probably the farthest behind in terms of ESG integration in terms of its investments, but also ESG with regards to its company's adoption of ESG factors overall. You know, we're looking at ESG from many different perspectives, right? Not only as to where it's being rated today, if you were just to look at companies today, what its ratings are. And there is debate as to whether there is value add with regards to looking at it from both a risk and returns perspective. You know, the angle that we're also trying to look at it from is also ESG momentum or ESG improvers perspective. And that's where you could potentially get more return potential, right? So, and how you look at that, especially relevant in Asia, would be, you know, maybe it doesn't rank very well from an ESG perspective right now, but where are the companies headed, right? So the potential for improvement and its intention for improvement. And I think that's where you get a lot more return potential when you're looking at ESG improvers. So even if it might be ranked poorly today, and really evaluating each of the individual companies and each of the individual regions and sectors within Asia, that's potentially where you can get a lot more return potential, and also more return potential, but probably less risk mitigation potential there. So, and we do believe that this is a space where you really do need to be active in, and so thereby utilizing more passive vehicles is probably a little more suboptimal than an active manager in this space.
Perfect, perfect. And Jaime, your final, let's say, thoughts, comments, something that you want to share as a final comment to our investors, to our distributors about China, anything that you, let's say, you want to leave as a concept from this conversation, please go on.
No, I think in general, the advice of keep on diversifying in terms of regions, in terms of different companies. I think the post-COVID world clearly set up a difference between the Asian markets and the Western Hemisphere. And I think at this point, the signals are sending us a better perspective on those markets, not perhaps to just move every investment there, but to have a much more diversified and consider much more Asia now than perhaps you would have done as an investors in the pre-COVID world. So that would be my last thoughts. Perfect.
May, your final comment on these, let's say, on the lessons or the message that you would like to share to us and to the public that kindly reserve time for this conversation.
Yes, so I want to thank you for giving me this opportunity to speak on behalf of Asia. I do think that there are lots of opportunities, particularly in Asia, as we mentioned earlier, from the point of where we are standing today in the recovery, but also, the very timely question on ESG, which is more of a longer term strategic opportunity within Asia. So I think it's at a very exciting time currently with regards to being invested in Asia.
Oh, that's great. That's great. And thank you very much, May, for your time. We know that you are very busy. Thank you very much also to Franklin Templeton. Jaime, I don't know if I'm missing someone to thank on the coordination of this event.
Yes, well, Sura also helped us in coordinating. So as I mentioned, we have a fund that's dedicated to Asia from the Sura team. So also thank you, the Sura team for.
Yeah, thank you, Sura. Thank you, Kimberly, for helping us on this, let's say, on this space. I'm going to translate it very quickly to Spanish, May, if you don't care. Y muchas gracias a todos por acompañarnos. Bienvenidos sus comentarios. La idea, pues, de este tipo de espacios es poderles, pues, llevar contenido, aprendizaje, experiencias de lo que está pasando en otros mercados. Estamos viendo, pues, ya desde hace algunos años una época donde, pues, como inversionistas tenemos que mirar y entender lo que está pasando en otras regiones, y pues sin duda Asia es de las regiones que hay que mirar y que hay que considerar como una opción de de inversión en el presente y en el futuro. Nosotros en Skandia, como lo comentó Jaime, lo hemos venido incorporando en nuestras estrategias y pues agradecerles nuevamente mucho el tiempo. Estaremos pues considerando este tipo de webinars cada vez más y más en el futuro. Muchas gracias. Jaime, no sé si quieras un comentario final.
No, muchas gracias, and thank you very much, May. It was a pleasure having you here, and hopefully we'll have you soon again.
Thank you very much, Jaime and Julio.
Perfect. Take care.
Thank you. Bye-bye.
Gracias a todos. Buen día. Hasta luego. Bye bye.